In the fourth question for Unit 11 exercises, 88 Corporation is going to buy out another entity. They're going to buy Pristine Pianos. And they're going to do so for $1 million on the dot. Well, Pristine Pianos, like all companies, would have been keeping track of their financials. They would have had a balance sheet that had the valuation according to their books of all their assets, of all their liabilities, of all their equity. We're buying all of that stuff, and it says that they have $1,010,000 of assets and $1,010,000 worth of liabilities and equity at the time that we are buying out this company. Well, whatever valuation they have on their different assets, on their different liabilities, is completely irrelevant to us, because the rules state that when you buy another entity out, you put the assets that you are acquiring in the purchase on the books, not at the book value of the entity that you're buying, but at their fair value at the time that you're acquiring them. So step one to go through is to look at all of the assets, liabilities, and etc. that you are acquiring and determine, is the fair value of those things the same as their book value? So 88 Corporation would have to do a very thorough review of Pristine's assets at the time they're buying them. They did so, and they realized that Pristine's inventory had a fair value of $175,000. The buildings that they're acquiring in this buyout have a fair value of $420,000, and the equipment has a fair value of $150,000. The rest of the stuff for assets we're assuming is the same. So as we can see here, inventory, buildings, and equipment very much have a different fair value than they do book value, which is entirely typical of anything. Your books and your fair value will be different on your assets pretty much at all times. So we need to put this on the books at fair value. What is the fair value of cash? Cash is typically at fair value regardless, so we will put this on the books for the same $200,000 that they had listed on their balance sheet. Accounts receivable, we have no information here that says we need to adjust it to a fair value, so we're going to put that on the books at $100,000. Inventory, however, is listed at $180, but its fair value is only $175. When we put it on the books, we put it on in fair value, not book value. So this is going to go on our books, on 88's books, for $175,000. Buildings, again, have a different fair value, $420,000, than book value on Pristine's books at the time we're making this acquisition. Well, we have to record those buildings at fair value, so $420,000. Equipment, while it's listed on Pristine's books at $120,000, has a fair value of $150,000. So we're going to put that on the books for $150,000. And then lastly, we have a trademark over here at $10,000. We have nothing in here that says we need to adjust this to a different fair value, so we're going to assume that that fair value of that trademark is the same as its book value of $10,000, which means the fair value of all the assets that we are acquiring is equal to the sum of each of their respective balances, and that comes out to be $1,055,000. So those assets have a fair value in excess of what Pristine had them on their books for at the time of acquisition. Well, let's do the fair value of our liabilities. Again, we have no information right here that tells us that the fair value of these has changed. So we can just put these on the books for the same book value that they were on Pristine's books for at the time that we were acquiring. The accounts payable is $90,000. Bonds payable is $340,000. Missing a zero there, $340,000, which means the total value of the liabilities that we are having to take on is $430,000. If you're buying out an entity and that entity owes people money at the time that you buy them, you're assuming that debt. So we're assuming $430,000 of Pristine's debt. Well, now we need to figure out the value of the net assets being acquired, and that is just the fair value of their total assets less the fair value of their liabilities. So we are buying $1,055,000. But we are also assuming $430,000 worth of debt, which means that the fair value of our net assets, the worth that we're getting, if you will, the equity of Pristine, is really $625,000. Well, we're not paying $625,000. I mean, that's what our look into the fair value of everything we're getting revealed as the true worth of Pristine at the time that we're buying them. But we're not buying them for that much. We are buying Pristine out for a cool $1 million. So the purchase price is $1 million. We are paying $1 million in order to acquire $625,000 worth of net assets. Well, we're paying a huge premium. And why are we paying that premium? Because we're assuming that having the pristine name and all of the inventory that they have and the trademark on that name, etc., generates goodwill with the public. How much? We're going to value it at the difference between what we're paying for it and what it's actually worth. That's $375,000. We could also be making this purchase above price because we don't want another competitor. I don't know what other competitor makes pianos, but we could have Galaxy Piano Corporation that would want to buy them out as well. We want to prevent our competition from acquiring this as well. So there's a lot of reasons that we would pay above, but regardless of what our rationale is, it's going to always be recorded as goodwill, the surplus that we pay in purchase price above what the company is actually worth at the time that we're acquiring it. So we are buying this on January 1st, 2018. Let's record the journal entry for this acquisition on January 1st. We're going to start by putting all of the assets that we are acquiring on their books, again, at their fair value. So we are acquiring cash with a fair value of $200,000. So we're going to debit cash, asset account increasing by $200,000. We get to transfer the $200,000 from Pristine's bank account to our own. All of the receivables that Pristine was eligible to receive from their customers at the time that we're buying them out are now due to us, so we get to increase our accounts receivable by $100,000. All of that inventory that Pristine had on their books now belongs to us because we're buying them out, and we're going to put that on at fair value, which was $175,000. Those buildings that Pristine had for manufacturing or housing inventory or whatever they did with the buildings now are our buildings. We're going to put them on the books at fair value, which is $420,000. All of the production equipment that Pristine had is now our production equipment. We need to put it on our books, so we're going to increase the value of our equipment by the fair value of the assets that we're acquiring, which is $150,000. And then, lastly, we are acquiring the trademark for Pristine Piano's brand name, which is carried on the books at a price of $10,000. We're going to skip a line here because we're also taking on some debt here. At the time that we acquired Pristine, they owed their vendors $90,000. Well, now that we're buying them out, we're obligated to repay that $90,000. So we need to increase our accounts payable by $90,000. Pristine also owed their bondholders $340,000 at the time that we bought them out. Well, now we own their bondholders $340,000, so we need to increase our bonds payable liability by that amount. And then lastly, we need to reduce our cash account by an amount equal to what we are paying Pristine Pianos to buy them out, and that was that full, I think it's getting crazy, I'm over here, $1 million. That was our purchase price. So our purchase price in this case is $1 million. Well, I'm willing to bet at this time that our debits don't equal our credits. Let's do a little bit of math here. Let's add up, find the sum of all of our debits. Let's find the sum of all of our credits and find out what the difference between the two is. And the difference between our debits and our credits in that journal entry is $375,000. Does that number look familiar? It absolutely does. It's the extra amount that we are paying to acquire this company. It is an intangible asset called Goodwill. So we are going to put that Goodwill on the books for $375,000. And to be thorough, we're going to do a double check one more time to make sure our debits equal our credits. So let's find the sum of all of our debits. Subtract out the sum of all of our credits, and it should be 0. They should be equal to one another. And a little dash means they absolutely are. So what did we do here? We purchased Pristine Pianos Incorporated.